The garbage business is inherently a dirty business, but throw in a massive accounting fraud and your business is downright filthy. In the 90s, waste management was starting to smell a little fishy, but it wasn't the trash. Today, we're talking about the time Waste Management's leadership carried out a $1.7 billion accounting fraud that cost shareholders over $6 billion. Waste Management was founded in 1968 and its growth strategy was acquisitions. The garbage game was fragmented, so buying up the little guys was a simple way to grow. Just 3 years later, in 1971, Waste Management went public, and by 1972, the company had made 133 acquisitions and was doing $82 million a year in revenue. By 1990, Waste Management was the largest national garbage company, and still growing. All seemed to be well through the 90s, until 1997, when Ronald LeMay was named CEO. Something seemed off, so LeMay ordered a complete review of the financial statements and then abruptly quit after 3 months. LeMay wanted no part of this dumpster fire because the past few years had not been as good as everyone thought. The investigation led to a $1.7 billion accounting restatement for 1992 to 1997, the largest restatement ever at that time. This was outrageous. How could the waste management industry ever be so corrupted? Never mind. The stock also absolutely tanked, wiping out $6 billion in shareholder value. So what did the investigation find? Well, there were 4 key players in the fraud. Dean Buntrock, CEO, Chairman, and Founder, Phil Rooney, President and COO, James Koenig, CFO, and Thomas Howe, Chief Accounting Officer. With these guys, it's more like waste mismanagement, am I right? Anyway, to commit the fraud, they used 5 key areas in their playbook. When a company like Waste Management buys assets that have long useful lives, like trucks, the value of that truck is expensed in bits over its useful life. It's depreciated. The depreciation equation is just the cost of the truck minus the salvage value, which is what you think you can sell the truck for after its useful life, divided by its useful life. What Waste Management started doing is changing the useful life of its front-loading trucks from 8 years to 10 years, and the life of its rear loaders from 10 years to 12 years, as well as doubling the salvage values for their trucks. Both these combined lowered depreciation costs and boosted profits. For example, if a new rear loader costs $250,000, depreciating it correctly costs $23,500 a year. Adding 2 years and doubling the salvage values lowers the depreciation expense by 22% a year to $18,333. With thousands of trucks, that adds up. Companies are allowed to alter these bits if they document sufficient reasoning, but Waste Management said, gosh darn the reasoning, and provided none. As mentioned earlier, some things need to be expensed, while others are capitalized and then depreciated over time. Waste Management was capitalizing things they should have been expensing, resulting in lower current costs. Something like a truck is depreciated over time. Pencils are expensed in the period purchased. Waste Management was just capitalizing willy-nilly and then spreading expenses over many periods. Waste Management, as many companies, had reserves for different things that could happen. This is an account that you put money away into, just in case you have to pay out on something one day, like a lawsuit. If there's a reasonable chance of it happening, you put the money away and expense it. If the thing doesn't happen, you just reverse the expense, no big deal. It's like getting back a deposit. You just end up spending less, not earning more. Waste Management couldn't be bothered to reverse expenses, so they were emptying a ton of reserve accounts they had and recognizing it as new income, which is a big no-no. As Waste Management's landfills were filled, the value of the land would decrease. Land values would also decrease if a landfill was abandoned, an expansion plan rejected, or anything happened that made the land worth less. When this happens, the asset has to be impaired and the amount expensed. The finance team at Waste Management just straight up ignored this and did not record these impairments, avoiding massive costs. There was nothing fancy here. They just took a "what problem? There's no problem" mentality to it. Netting is recording the net gain or loss from multiple transactions instead of recording all the revenue and all the expenses separately. So, for example, if I owe Waste Management $100 and Waste Management owes me $75, instead of Waste Management recording revenue of $100 and an expense of $75 like they should, they would just record revenue of $25 and no expense. This seems okay, but recording only the net doesn't show the full picture of the transactions, and it's also against the rules. Finally, geography entries is just a fancy way of saying doing whatever the heck you want. The geography is the location of the accounts in the income statement and just blatantly moving revenue and expenses to whatever category you want. Why not? That was the gist of it, but how did they get away with this? Well, the basic answer is that management was in on it. It was just blatant fraud. Waste Management's auditor, Arthur Anderson, yeah, same guys, they were in on it too. They had raised concerns to Waste Management when they initially found the fraud, but Waste Management just bribed them, which Arthur Anderson gladly accepted. Before we talk about the aftermath, why did this even happen? Greed was a lot of it, but the company needed to keep up with expectations. As a public company, analysts and investors have earning expectations, and the stock takes a hit if the company doesn't perform. Waste Management would use their stock as currency for acquisitions. So as the garbage game consolidated, acquisitions became more expensive, requiring a strong and stable stock price. A weak stock meant less buying power, meaning less growth, causing Waste Management to underperform and the stock to fall, which means less buying power, etc., creating a vicious cycle. Management was definitely feeling pressure to keep the stock price up, to continue growth, and to get their bonuses.
You were the clock that was ticking in my home. Changed my state of mind.
Ladies and gentlemen,
Love so hard to find.
we got him.
So, like with most white-collar crimes, nothing really happened. Shareholders were left holding the bag, losing $6 billion as the stock tanked, and it took more than 7 years to recover. The 4 key guys who were identified for the fraud, Dean Buntrock, Phil Rooney, James Koenig, and Thomas Howe, were all banned from being directors or officers of a public company and basically just gave back their bonus money. Buntrock had earned about $16.9 million from this and had to return $19.4 million. Rooney earned $9.2 million and returned $8.7, still made a profit. Koenig earned $900,000 for his part in the fraud and had to return $2.5 million. Howe earned $600,000 and had to return $1.6 million. Ouch. Nobody served time in jail, and they didn't even have to admit guilt. The total settlement was over $30 million. Not bad for losing shareholders 200 times that. And our old auditing friend, Arthur Anderson, well, they only got fined $7 million by the SEC. They can recover from that, but I sure hope nothing bad happens to them on August 31st, 2002. Waste Management has since recovered and is now worth around $60 billion, 5 times as much as when the scandal happened. No matter what, business must go on. It's funny though, if you commit crime as a waste management consultant, you get hit with racketeering, extortion, corruption. But if you commit crime as an executive of waste management, it's just called business and everybody moves on. But remember, none of these guys had to admit guilt. I guess even executives live by the timeless rule. No matter what, you never admit to the existence of this thing.